Now let's look at the International Monetary Fund and the World Bank, the two leading institutions of international development today. As previously indicated, both the International Monetary Fund and the World Bank were created at the 1944 Bretton Woods Conference. At that time, World War II was beginning to wind down, and the Allies were anxious to create a new international order that could rebuild Europe while facilitating closer connections between the countries to prevent another war. The system that was created was the Bretton Woods system and centered on two key international institutions underscored by the US dollar-based reserve system discussed in the previous lecture. The International Monetary Fund would be responsible for providing short-term loans to aid countries in meeting balance of payments obligations. The primary purpose of the organization was thus to provide fiscal and exchange rate stability for the global economy. Today, the IMF has a total lending capacity of about $360 billion. The World Bank was established to directly aid in the reconstruction of Europe by providing long-term development loans to member states. As Europe rebuilt and the former colonial states began to secure their independence, the World Bank shifted its focus to help achieve development in the global south. Today, the World Bank's official mission is to help reduce global poverty. The World Bank has a total lending capacity of about $52 billion, about 1/7 that of the IMF. Although we often talk about the World Bank as if it were a single organization, it is in fact comprised of several distinct groups. The International Bank for Reconstruction and Development offers loans to middle-income developing countries, generally to fund large-scale infrastructure projects, education, energy investment, healthcare projects, or projects to expand access to food, water, and sanitation. Established in 1960, the International Development Association is focused on the provision of concessional loans, loans offered at below the market rate of interest, and grants to the world's poorest developing countries. The IDA's stated mission is to assist the poorest countries to quickly, equitably, and sustainably reduce poverty and promote more rapid economic growth. Loans from the IDA are often used to fund programs like the provision of childhood immunizations, recruiting and training teachers, and constructing infrastructure. Ideally, as countries develop, they're able to transition from the IDA to the IBRD. The International Finance Corporation provides investment advice and asset management services intended to encourage the expansion of the private sector in the Third World. While technically a private corporation, the IFC's sole shareholders are its member states, who vote on the decisions of the corporation in proportion to their monetary contributions. The IFC was established in 1956 and focuses on for-profit and commercial projects which help reduce poverty and promote development. Its primary areas of focus include agriculture, healthcare, education, microfinance, and assisting small businesses. The Multilateral Investment Guarantee Agency was created in 1988 to promote foreign direct investment into developing countries and to support economic growth, reduce poverty, and improve people's lives. The MIGA focuses on countries that are part of the IDA and countries that are affected by armed conflict. The MIGA encourages foreign direct investment by providing insurance against political risk, by ensuring foreign investors' losses against government expropriation, war, terrorism, or other threats of political instability. Finally, the International Center for the Settlement of Investment Disputes was established in 1966 to provide a legal forum to resolve disputes between international investors. It can arbitrate disputes between governments and companies in an effort to reduce the level of political risk associated with investing in the developing world. Both the IMF and the World Bank organizations are technically responsible to the member states, but this has generated some controversy. Both organizations employ a weighted voting system that gives member states a number of votes equal to the share of the organization's budget they provide. In the International Monetary Fund, for example, a country's quota, think of these as dues, are determined based on the size and openness of the economy, the degree of economic stability in the country, and the size of the country's foreign reserves. Based on these figures, a country's quota is determined. The United States, for example, provides about 17% of the IMF's total budget. This entitles the United States to about 17% of the votes in the IMF. The world's poorest countries, by contrast, may have as little as 3/100ths of a vote. The World Bank allocates votes through a similar mechanism. This system has three important effects. First, because the IMF and the World Bank operate on the basis of a supermajority vote, large stakeholders like the IMF and the European Union are effectively granted veto power over the decisions of the organization. Second, because of their historical importance, the United States and the European Union have informally divided the leadership of the two organizations between them. By tradition, the managing director of the IMF has always been a European. The position is currently held by Christine Lagarde, the former Minister of Finance for France. Similarly, the president of the World Bank, by tradition, has always been an American. This post is currently held by Jim Myung Kim, a Korean American appointed by Barack Obama to the post in 2012. Third, and perhaps most importantly, the voting system employed in both organizations means that countries that are most often subject to the policies established by the organizations often have the least influence in crafting those policies. With its 17% of the IMF vote, the United States has roughly 3 times the influence as all 53 African members of the IMF, which collectively share just 6.78% of the votes, roughly the same number as Japan, with 6.53% of the votes. This means that developing countries in general are less able to influence the policies or agenda of the international financial institutions, even while they disproportionately are affected by those policies. The International Monetary Fund's primary purpose is to maintain currency stability and to provide assistance to states in meeting their balance of payments obligations. When a member state is unable to meet its international obligations, the IMF can provide emergency loans to allow them to continue to finance their operations. The most dramatic example of this occurs during currency crises, such as those that occurred in Mexico in 1994, or the Asian financial crisis of 1997, or the Russian ruble crisis of 1998. In each of these crises, internal economic challenges combined with external pressure, particularly in the form of financial speculation, to spark the crisis. In the Russian crisis, for example, domestic political instability combined with economic stagnation and a speculative attack on the Russian ruble. The Russian government had been spending its foreign currency reserves to try to maintain the ruble in a narrow price band between 5.3 and 7.1 rubles to the dollar. Under this system, the Russian government would sell rubles if the price dropped below 5.3 to the dollar, and would buy rubles if the price exceeded 7.1 to the dollar. Some $3.98 trillion in global currency transactions, usually abbreviated as FX, take place daily. To put that number in comparison, the total global annual foreign direct investment in 2011 totaled $1.3 trillion. 3 times as much money is traded on global currency markets in a single day as flows in the form of foreign direct investment between all the countries of the earth in a year. The world total GDP is estimated to be between $70 and $80 trillion. More currency moves through the global foreign exchange markets in less than a month than is produced by the entire planet in a year. If we look at the annual rate of currency transactions, we see how crazy the picture becomes. The vast majority of currency transactions are speculative in nature. That is, investors are betting that the value of a particular currency will increase or decrease in the future, and make huge profits from those fluctuations. Such transactions have no productive or consumptive component. Speculators are not buying or selling currencies as part of a broader economic transaction, such as investing in another country or purchasing oil on global markets. Rather, they are betting that small changes in the value of a particular currency. While such bets provide liquidity to the market, that is, they ensure there is a ready supply of buyers and sellers, they also have the effect of amplifying upward and downward trends or volatility in the market. In other words, their activity helps to create bubbles and bursts. When speculators began selling Russian rubles in 1998, they created a sharp downward pressure on the value of the ruble, reflected in this chart in the upward price number, meaning that it took more rubles to purchase $1. The Russian government responded by buying rubles, selling dollars it held in reserve. As the Russian government ran out of dollars, it was forced to turn to the IMF for additional dollars, which it used to buy rubles in an attempt to maintain the value of its currency. However, because speculators had access to more currency than the Russian government did, the Russian government's policy was ultimately defeated, and the value of the ruble collapsed. At the beginning of 1998, the ruble was trading at a rate of just under 5 to 1 to the US dollar. By January of 1999, it was trading at about 15 to 1. But remember that Russia had sold all of its dollars and had taken between $5 and $17 billion in additional foreign loan obligations to defend the ruble. Like most debt taken on by the developing world, these were dollar-denominated obligations, meaning that they had to be repaid in US dollars. But in an effort to maintain the value of the ruble, the Russian government had sold those dollars and purchased rubles, which were declining in value. At the end of the crisis, the Russian government held billions of rubles, which were worth far less than the dollars they had been purchased with. And to make matters worse, their international debt was still priced in US dollars. They had between $300 million and $5 billion worth of rubles, but owed between $5 and $17 billion to international creditors. At the same time, to receive those loans, the Russian government had to agree to undertake a series of economic reforms and political reforms broadly classified as structural adjustment programs, or SAPs. Structural adjustment programs were the policies required by the World Bank and the International Monetary Fund as a precondition for the receipt of loans. Because of this, they are sometimes called conditionalities. In general, adjustment required the implementation of free market reforms as envisioned by the Washington Consensus. In 2002, structural adjustment programs were replaced with poverty reduction strategy papers and poverty reduction and growth facilities. In theory, both were intended to create greater buy-in and ownership on the part of the developing world in the structural reforms they were required to take by the IFIs. They were seen, in other words, as breaking from the traditional model of IFI-imposed conditionality and shifting instead to developing country-based policies. In reality, though, very little changed, and the content of the policies continued to look remarkably similar to the structural adjustment programs of the 1980s and 90s. SAPs and their successors have come under strong criticism. Many developing countries argue that they represent the wrong policies wrongly applied. As countries liberalized, they actually suffered declines in economic growth. Sharp cuts in government spending disproportionately affected women, children, and the poor, as traditional state functions like the provision of health care and education were eliminated or transferred to the private sector. At the same time, rather than generating economic growth, structural adjustment frequently resulted in an economic slowdown, increasing unemployment and lowering wages. Not surprisingly, structural adjustment thus also generated considerable popular protest, including sparking IMF riots around the world. In Bolivia, for example, thousands of people protested the sharp increase in the price of water associated with SAP-imposed privatization. The map here provides a broad overview of anti-SAP IMF riots from around the world.